Welcome to the deep dive. Today we're tackling, well, a real puzzle in the market's reaction. We're going deep into the Q2 fiscal 2026 earnings call for MIND Technologies. That's ticker MIND, which happened just back on September 10th.
Yeah, and this was fascinating because you got this immediate paradox, right? You see the numbers and they look solid, come back to profit after some Q1 struggles with deliveries.
Right.
But then you look at the market reaction and it was just deeply skeptical, a huge sell-off. So why did the fundamentals and, investor feeling split so dramatically? That's what we need to unpack.
It really is a head scratcher. They hit the numbers, the stock tanks. Okay, let's lay out the facts first. The Q2 results themselves, they were a clean beat, weren't they?
Absolutely. Revenue, $13.6 million.
Yeah.
Which is a big jump.
Huge jump, like 35% year over year.
Yeah, about that. And sequentially even bigger, up 72%. That was mostly catching up on those delayed Q1 deliveries.
And the profit picture?
Back in the black. GAAP EPS came in at 24 cents. That beat the street by 4 cents. And adjusted EBITDA, which, remember, was slightly negative in Q1.
Barely, yeah.
Roared back. Positive $3.1 million. Strong turnaround. Plus, the balance sheet looks good. $7.8 million in cash, no debt. Pretty solid foundation.
Okay, so strong numbers, debt-free, beat estimates. But like you said, if you watched MIND on September 10th, it was ugly. The stock just sold off hard. Closed down, what was it?
14.5%, a really sharp drop.
Wow. So that tells you investors just looked right past those Q2 numbers. They were worried about something else entirely.
Exactly. It was like the market said, okay, thanks for the history lesson, but what about tomorrow? That's selling pressure. It screamed concern about forward visibility. They wanted clarity on what's next, and they clearly didn't like what they saw or maybe what they didn't see.
All right, so let's connect that profitability back. Where did it come from? Gross margin was key, right?
Totally key. Gross profit margin was really strong, hit 50%. That's $6.83 million in gross profit. Big improvement, both from Q1 and from last year.
And the driver behind that 50% margin?
It boils down to the mix. Product mix. Management was pretty clear. Aftermarket stuff. We're talking spare parts, service calls, repairs, upgrades. That was the big engine here.
Okay.
For the first half of the fiscal year, aftermarket was something like 68% of their total revenue. And that stuff usually carries much better margins, less discounting than you see on the big competitive full system deals.
So they have this structural base of high margin, recurring-ish revenue. That sounds fantastic.
It is fantastic. It provides a kind of floor for the business.
Then why the panic selling? If the aftermarket is so strong, where's the disconnect?
Now we get to it. The backlog. Or maybe the lack of backlog. That was the single biggest worry.
Right. This must be the linchpin.
Absolutely. The firm backlog for their CMAP systems, it dropped quite a bit. End of July, it was down to $12.8 million. Compare that to the end of Q1, it was $21.1 million. And in this marine tech space, it's volatile. A shrinking firm backlog. That always spooks investors. Always.
Okay, so management had to address that on the call. What did they say? How did they defend that big drop?
Well, they said it was not unexpected. Their argument was, look, we shipped a ton of stuff in Q2, hence the 72% sequential revenue jump. So naturally, the backlog came down.
Makes sense on the surface.
But then they immediately tried to pivot to the pipeline. So they had two specific orders, imminent orders totaling about $10 million. The CEO used the phrase, highly confident these would convert soon. And if they do, poof, the backlog is basically back to Q1 levels.
Hold on, highly confident, imminent. That sounds like, standard CEO talk, doesn't it? Why should investors trust a promise, even a confident one, over a signed contract? Especially with all the talk about macro headwinds.
That's the million-dollar question, isn't it? Or maybe the $10 million question here. And that 14.5% drop tells you exactly how much the market valued that confidence. Pretty close to zero. Traders punished the stock for the backlog number they could see, the $12.8 million, not the promised $10 million. They want proof, ink on paper.
So it really comes down to whether you believe those orders are truly imminent or if it's wishful thinking.
Precisely. Do you buy the story now or wait for the press release?
Okay, shifting gears a bit. Let's talk outlook. Management's tone was cautiously bullish. What does that translate to in terms of guidance?
They said they're still bullish on the balance of this fiscal year. They expect to stay profitable, keep adjusted EBITDA positive each quarter for the rest of FY26. But, and this is important, they did signal things are slowing down a bit from the recent growth spurt. They expect full-year FY26 results to look similar to that of fiscal 2025. So, moderation.
Similar to FY25 implies a significant slowdown from that 35% year-over-year growth they just posted, right?
Yeah, exactly. And they pointed fingers at the reasons.
Which were the macro stuff.
Yep. Broader economic uncertainty. Customers are apparently taking a wait-and-see approach, hesitating on big purchase decisions. That's hurting visibility into next year, FY27, and slowing down commitments. They specifically mentioned softness in the seismic market and also some sluggishness in U.S. offshore wind activity.
So industry-wide caution, not just a mind problem.
Seems like it. These sound like systemic headwinds affecting big capital spending decisions across their customer base.
But it's interesting. They're citing caution from customers, yet they're expanding their own operations. Tell us about that Huntsville facility expansion.
Right, that's the other side of the coin. The strategic long-term view. They finished expanding the Huntsville facility back in August. It's ramping up now. The plan is not just bigger manufacturing, but critically doing more third-party repair work.
Third-party work, more service revenue.
Exactly. Management thinks this expansion could potentially add 10% or more to annual revenues down the line. Plus, doing that work in the U.S. gives them, shelterable U.S. income. Good for taxes, good for cash flow. It feels like they're making these structural moves to smooth out the business, make it less lumpy, even if the short term looks a bit choppy.
Okay, one more strategic piece before we get to the trade idea. That dual announcement back in late August, they announced an ATM program and a stock buyback at almost the same time. That definitely got analysts asking questions.
It did raise some eyebrows, yeah. But I actually think it's pretty clever. It's like building a financial Swiss Army knife. Gives them maximum flexibility.
How so?
Well, the ATM, the at-the-market program, lets them raise cash if they want to, but opportunistically. They said it's earmarked for disciplined M&A, small, tuck-in deals, technology that fits their current customers. They specifically said no big, risky step-out acquisitions.
So the ATM is potentially for offense buying things. What about the buyback defense?
Exactly. The buyback is the counter move. It lets them soak up any dilution if they do use the ATM. Or maybe more relevant given the stock drop, they could use cash to buy back shares if they think the market is hammering the price unfairly, like, say, after a 14.5% drop.
Okay, so they're armed for opportunities or for defense, depending on what happens, creating options.
Mandatory optionality, ready for anything. Deploy capital externally via M&A or internally via buybacks. Smart.
Right. That sets the stage perfectly. Strong underlying business, high margins from aftermarket, but this huge cloud of uncertainty over the backlog and the near-term order book.
Okay. I think it's time. Time for that segment where we connect some dots, maybe stir things up a little.
Where we absolutely have to remind you this is just us talking, brainstorming ideas based on the market action.
This is not financial advice, seriously.
Okay. So the core idea, the thesis here, is pretty straightforward. The market smacked this stock purely because of that short-term backlog dip, that lack of immediate visibility. And in doing so, it feels like it completely ignored the really solid, high-margin aftermarket business that provides that structural floor. And it ignored management's high confidence in that $10 million catalyst.
Fear trump fundamentals.
Fear created this gap, this divergence. You've got underlying strength, but near-term panic.
So given that setup, what's the outrageous but plausible trade idea to play this tension? Okay, so I'm thinking a pair trade, something that plays both the short-term uncertainty and the potential long-term recovery. Capitalize on the volatility around whether those imminent orders actually show up.
All right, intriguing. How does this pair trade work? Walk us through it.
So first, acknowledge the current negativity, that sharp sell-off. It suggests a technical breakdown. If those big orders don't hit the newswires soon, the pressure could continue. So the trade assumes maybe imminent doesn't mean like next week. Maybe those $10 million orders take longer than management hopes. Maybe they don't hit before the next earnings report.
Okay, so bet against the immediate conversion.
Sort of. Action one, short-term bearish. You could initiate a small short position, or maybe safer, buy some near-term put options, say 30, 60 days out. You're basically betting that the negative sentiment and selling pressure linger if there's no positive news on those orders quickly. It's a hedge against the current fear.
Right, playing the downside momentum. But you called it a pair trade. What's the other leg? The bullish part.
Action two, long-term bullish. At the same time, you go long, but long dated. Buy into the money call options, maybe 12 months out, maybe even further. This is the bet on the fundamentals eventually winning out. You're betting on the Huntsville expansion ramping up successfully, adding that high-margin third-party work. You're betting on that strong aftermarket floor holding firm. And you're betting that eventually, whether it's next month or next quarter, that $10 million pipeline does convert into real signed orders.
So you're aiming for a recovery back towards those prior highs.
Exactly. aiming for a move back toward or even past that $10.22 high we saw before the earnings call once the market sees the proof and the long-term trajectory becomes clearer again. It's a play on the market correcting its overreaction.
That really captures the tension, betting on short-term pain but long-term gain. Okay, let's wrap this up. The core takeaway seems clear. Mine Technologies, ticker MINDAY, they delivered the financial goods in Q2. Profitability is back, driven by those really strong aftermarket margins. But the market is completely fixated on that $10 million question mark in the pipeline and the general macro fog slowing things down for next year.
Right. And here's the final thought I want to leave you with, something to chew on. Think about the old mine. It was all about these huge, lumpy system orders. Feast or famine, right?
Yeah.
Big wins and quiet periods. But now, almost 70% of the revenue in the first half came from aftermarket. Stable, high-margin service and parts. That's structurally different.
And if that structural floor is real, and then you add the Huntsville expansion bringing in potentially consistent third-party repair work, is this even the same kind of company it was a few years ago? The market might still be viewing it through that old lens, panicking about the system order backlog, but maybe management is quietly turning it into more of a services-led, higher-quality revenue business. If that shift is happening, maybe that de-risks the whole operation in a way that hasn't been fully appreciated yet. How much do you trust imminent versus ink on paper? That's the real question.